In this lesson, we'll review goodwill and the process for goodwill impairment. So far, we defined goodwill as a formula. We said it's the 100% purchase price over the 100% fair value of the subsidiary. But what does this really mean? Goodwill is basically that something extra a company has that makes it more valuable than just the fair value of its assets and liabilities. Things like brand recognition, being known for good quality, or people loving the company because they're known for giving to charity. It's this nebulous thing that you can't put your finger on, but has value. Here's the thing though, it's such a nebulous unknown that you cannot create it and record it as an asset yourself. So here's the rule. You can only record goodwill when there is an acquisition. That's it. That's the only time. So if you're trying to spend money to increase or create goodwill, those expenditures do not get capitalized as goodwill. You only record goodwill when there is an acquisition. Now, goodwill is something you can't touch. It's an intangible, and we don't know how long it's going to last. So it has an indefinite life. Make note, assets with an indefinite life are not amortized. Instead, they're tested for impairment. And this happens at least once a year and more often if events and circumstances indicate that goodwill may be impaired. Note, it doesn't matter when you do the impairment test as long as you do it at the same time each year. Let's try a multiple choice question. The question reads, a company should recognize goodwill in its balance sheet at which of the following points? Before we go through the choices, let's form an answer in our minds. When does goodwill get recognized on the balance sheet? Remember the rule. Goodwill only gets recognized as an asset when there is an acquisition. Now let's go to the choices. A. Costs have been incurred in the development of goodwill. Can we develop goodwill and record it on the balance sheet? No. The rule says you only get goodwill in an acquisition. B. Goodwill has been created in the purchase of a business. This sounds like what we've been saying, that you only get goodwill in an acquisition, a purchase. Let's hold on to this one. C. The company expects a future benefit from the creation of goodwill. Can a company create goodwill? Not without an acquisition, and there's no mention of an acquisition here. Out. D. The fair value of the company's assets exceeds the book value of the company's assets. This is trying to confuse you. It's trying to mix up when you mark to market and when you recognize goodwill. Just visualize our calculations and remember, goodwill is the difference between the 100% purchase price and the 100% fair value, not the difference between fair value and book value. So the answer is B. Back to the rules. Goodwill is tested for impairment in one of two ways. You can either go right to the quantitative testing, meaning you go right to the numbers. But the numbers take a lot of time and effort because you have to start putting fair values on assets and liabilities. So FASB gave us an alternative. Oh, that FASB. First, do a qualitative screening, meaning look at everything that's going on in the world and inside your company. How's the economy doing? How's the industry doing? How's the company doing? Based on these events and circumstances, if it is more likely than not that the fair value of a reporting unit is lower than the carry value of that reporting unit with goodwill included, then you have to move on to the quantitative test. But if that more likely than not standard is not met, then that's it. You don't have to do the quantitative test. Now, what is a reporting unit? It's an operating segment or a component of an operating segment that has discrete financial information and where management reviews the operating results of that component. Keep in mind, goodwill impairment is tested on the reporting unit level. Now, if goodwill and another asset group are tested for impairment at the same time, then the other asset group gets tested first and records any impairment first before goodwill is tested for impairment. Lastly, let's talk about IFRS. Under US GAAP, we test goodwill impairment on a reporting unit level. Under IFRS, we test goodwill on a cash generating unit level. That's the smallest group of assets that generates its own cash flow independent of other assets. Under IFRS, we compare the carry amount of the cash generating unit and the recoverable amount of the cash generating unit. The recoverable amount is the greater of the fair value less cost to sell and the value in use, which is the present value of the future cash flows. I know this seems like a lot of words, but commit these IFRS definitions to memory because you'll use them again when you study asset impairment. Learn it once, use it twice. Back to IFRS. Under US GAAP, we test and record impairment for other asset groups first before goodwill. Under IFRS, you impair the goodwill down to zero first and then prorate the remaining impairment to the other assets based on their carry value. Let's try a multiple choice question. Under IFRS, which of the following adjustments should be recognized in the company's consolidated financial statements? They're asking for IFRS. Make a note on the top of your board. Let's go to the rest of the prompt. A company is completing its annual impairment analysis of the goodwill included in one of its cash-generating units. The recoverable amount of the CGU is $32,000. The company noted the following related to the CGU. They give us some numbers. Under IFRS, which of the following adjustments should be recognized in the company's consolidated financial statements? They give us the recoverable amount. And just eyeballing the answer choices, we see decreased goodwill in every choice. This is a goodwill impairment question. Under IFRS, we compare the carry value of the CGU and the recoverable amount. If the recoverable amount is smaller than the carry value, you write down the carry value to the recoverable amount. And we do this by reducing goodwill to zero first and then prorate the remaining impairment to the other assets based on their carry value. Let's plug in some numbers. What's the recoverable amount for this CGU? They give it to us in the prompt, $32,000. Now, what's the carry amount for this CGU? They break it down by goodwill, patents, and other assets. We just want the total for the CGU. That's the $45,000. So we have $45,000 on our books, but the recoverable amount, which is the IFRS version of fair value, is $32,000. That means the $45,000 on our books is too high. How much is too high? $45,000 less $32,000 equals $13,000. We have to reduce the carry value by $13,000. And remember the rule. First we reduce the goodwill down to zero. Then we prorate the remaining impairment to the other assets based on their carry value. So first, this $13,000 impairment gets taken out of goodwill. And goodwill is $15,000, which makes it large enough to absorb all of the impairment. There's nothing remaining to prorate. That's it. Answer A. All right, guys, we're almost to the end. Next up, last one, we're going to review the calculation for the partial goodwill method under IFRS. You want to be sure to hit these points on the exam, so stay with me. I'm Liz Cho with Test Prep in a Snap.